Hi guys, it's Dr. Robinson. This is the February 18th, 2023 meeting of the Money Masters Investment Club. Our itinerary today is not going to be that much. There's a few things to talk about, but the itinerary itself is just a couple of things. We're going to look at the financials and the volatility, or more correctly, the lack of volatility in the market. So guys, this is a slide I've been hesitant, or not hesitant, I've been dreading showing you. You can see over the last 2 weeks, and this is a 2-week chart, by the way. I didn't do a meeting last week. I was just trying to work out the accounting and kind of licking my wounds a little bit. But on 2/4, we had a closing NAV at 26.43. We ended up with a total loss over the last 2 weeks of $2.87. So our ending NAV 23.56. Believe it or not, nearly 11% loss over the last 2 weeks. It's been bad. It's not as bad as it was. If we go back 2 weeks ago, our losses at that time were actually in the $3.40 range. We had some pretty bad losses. Actually had a pretty good week last week, even though we weren't able to make as much money as we normally do. We did make some money last week. We got back to where, not where we were or anything like that, but we got back into some positivity in terms of making money again. What I have done though, and I think it's going to take me another couple of weeks to get this to repair the damage. But what I've had to do, because the market is kind of moving neutrally, it's just moving sideways more than it is in any direction, is I've cut down the number of shares or contracts I'm buying. So instead of buying typically 1,000 contracts or maybe sometimes even more, I've cut it down to about 450, so that if I have to strangle, I can strangle at 900 fairly quickly. And from there, if I have to strangle, I can strangle at 2,800. And the reason I mentioned that is because 2 weeks ago, one of the problems I had and what made our loss so big is I actually ran out of money in trading. Now, if you think about it, on a typical day, I trade with $2 million in the account. The rest is in our strangle. So when I've got $2 million, now normally $2 million is more than enough to do whatever, the things I'm trying to do. But 2 weeks ago, I actually ran out of money trading because I ended up having to strangle it so many times because the market was just back and forth so much. But if you imagine going through $2 million of options purchases in a single day, you'll know the kind of mess that we got into on that particular day. I'm not going to go through all the details about how it happened and what happened. I think it's pretty clear what happened. The market just died on us, and it just wouldn't move either way. A strangle, and we've talked about this in terms of our long-term strangle, but whenever we do a corrective trade, we call it hedging or strangling. What you need to do is you need the market to move one direction or the other. When the market starts moving sideways, you get trapped on both sides. And if you get trapped on both sides, then you end up holding, and I ended up having to strangle so many times 2 weeks ago that we ended up at one point holding about 10,000 contracts. So when you're holding that many contracts, and remember, when you're holding 10,000 contracts, every penny move is a $10,000 gain or $10,000 loss. So you can't have the market move too much before you have to either get out of that position or take the opposite position or whatever it may be. But when you've got so many calls and so many puts at the same time, you can't have the market move sideways, and that's what ended up happening. The market moved sideways, and there was no way to get out of the trade, and that's where the loss occurred. But having said that, some of the things we're doing right now to kind of reduce our risk as the market continues moving sideways is we're lowering the contracts. So instead of opening position at 1,000, we're doing 450. And that keeps me under, if I have to double, it keeps me under the $1,000 limit or 1,000 contract limit. And it's not a limit in the traditional sense. It's just I have to go through some different steps to take a position when I do more than 1,000 contracts. So, and sometimes that takes time. And when the market is moving like this, you don't have a lot of time. So to hit one button trading, I want to keep it under 1,000 contracts if I can. Sometimes I can't, but if I can, I want to do that. So that's why I've chosen the 450. So that if I strangle, I'll strangle at 900, and I'm still under the 1,000 contract limit where I have to put in a trade manually. So having said that, I think we're going to get this back, guys. It's just it's not a thing. I think so. I'm going to. It's going to take me a couple of weeks simply because I've reduced the amount of options we're buying and trying to be a little bit more safe with and it's not necessarily always unsafe. It's just one day blew this thing right out of the water. But the same thing that's happening here, by the way, is happening to our strangle, our long-term strangle. So right now, the calls in our long-term strangle are out of the money by $2.11. The puts are in the money by $2.61. As you'll notice, our puts, even though the market is trending down slightly, it's just a very slight downward trend. I got a chart, and I'll show you that in just a second. Our puts are starting to get a little long in the tooth, so we're starting to lose a little bit of theta. Now remember, and I don't talk a lot about theta with you guys. We talk about it a lot in our daily meeting and stuff because that theta is a real thing. But when you buy a long-term option, theta is not really bad until you get about a month, month and a half out from expiration. We're not quite there yet, and I think that theta could come, start reducing a little bit if the market could find some direction. But right now, the market is not finding any direction, and theta is starting to eat us alive a little bit. Now, for those of you who don't remember or don't know what theta is the time decay in an option. Remember, the difference between stocks and options is that stocks are long-term. Once you own a stock, like for example, Apple stock, you own it forever. So if the stock goes down, you can wait it out. It might take a year, could take 2 years, could take just a couple of weeks for the stock to come back and have some profits in it. With options, we don't have time. We don't own them forever. They have expiration dates. The longest option you can buy what we do is a 9-month option. There are some 3-year options out there, but they're so expensive we don't touch them, and they're not available in the regular markets. You have to buy those with individual stocks, and those are called leaps, by the way. We don't do leaps. We don't trade leaps at all. They're just too dangerous and they're too expensive. But when you buy, let's say, and we typically buy 3 to 6 month options. When you buy a 3-month option, they're still a little bit more expensive than what we would see on a day-to-day basis. But that theta doesn't really start affecting anything until you get closer and closer to the expiration. And that's what's starting to happen. Now, again, we've got a little bit of time left, so I don't have to make a decision if I don't need to. But I'm going to have to make a decision if the market continues acting like this. If the market continues to move sideways, I'm going to have to take some action because I got to try to protect the gains we have over on the one side versus the losses on the other. Because if the market continues to move sideways, even the gains, even the side that's on the right side is going to start to lose money because the theta or the time decay is going to increase every day we get closer and closer to expiration. So again, if I can put it off, I'll put it off, but I can only put it off if the market picks a direction and goes. Now, I do think we've turned the corner on the market. I'm not sure. The market has been bullish the last few weeks simply because a lot of people believe that the Fed was going to be able to lower interest rates later this year. I think that's off the table. Now, the market hasn't fully digested that yet, but there are a lot of Fed speakers over the last 2 weeks, way too many for my comfort. But those Fed speakers have all been fairly hawkish in terms of they expect interest rates to have to go higher faster. In fact, in the March 22 meeting, the expectation is now that we're going to see a 50 basis points increase in the interest rate. Now, I'm not entirely convinced yet. I still think the Fed's going to go a little bit slower. But if you've heard or read any of the comments from Bullard and from Mester out in San Francisco, those comments were very, very hawkish in that they think that the interest rate is going to have to get into, and I'm talking about the Fed funds rate, it might have to get to 550 or higher. And that's well beyond, that's almost 100 basis points above where everybody expects it to be or expected it to be just a few weeks ago. So having said that, the market is starting to kind of come to the realization there are no interest rate decreases this year, and therefore maybe the market's gotten ahead of itself. Now, there are still a lot of people out there who believe we're actually in the beginnings of a bull market, and we may well be. And that would explain why we're in this, we would call this a consolidation period, by the way. Normally, when you change from a bull to a bear market or a bear market to a bull market, you go through this consolidation where the market wants to spend time going sideways. And that's what's been happening. We've been going sideways now for the better part of 2 months. Possibly, if you look at it from a narrow point of view, you could say for 3 months, we've kind of gone sideways. It's made trading kind of difficult. That's caused the VIX to come down. And we're big believers or big followers of the VIX. So the VIX has come down quite a bit. In fact, it's been hitting close to 17 in over the last few weeks, although right now I think it's popped back up to 20, mostly as a result of yesterday and the day before. But in any event, that's where we're at on our long-term strangle. But again, I am going to, assuming that nothing changes in the next week or so, I am going to have to make some changes in the strangle to kind of take care of that or to deal with the theta. So I want to prepare you for that. So having said that, that's where our current strangle is. What I wanted to show you is that why are we going through all this? Why so much struggle in the market? And if you kind of look at this, if you look at the dotted line, the green dotted line here, we kind of extrapolate in the market. This is called technical analysis. So what we kind of do is we kind of look at where the market's hitting lows and what's the trend line. Now, some people go by the highs or you can go by the lows, either way. But if you go by the trend line here in the green from somewhere in January, I don't know what that actual date is that I started this line from. But if you go from January up to about February 4 or February 2nd, you can see the trend line was solidly positive. And it looked like we were going to break out. That's why a lot of people thought, man, maybe this bear market we're in, it's finally over, and the stock market can finally get back to making money for people, and people's IRAs can heal and stuff. But look what happened on February 2nd. It stalled, and it has not been able to make any real new ground since then. It's been down, it's been up, down and up, but overall, you can see the trend line there, that red dotted line, the trend line is slightly negative. So the trend line, so our puts, on our long-term trend, our puts are starting to make a little bit more money. So they are kind of building up a little bit, but it's taking so long that the time decay is going to really hurt that if it continues in this trajectory. Now I'm hoping that if you look at the to the right there, you see where the red line and the green line kind of meet, and then they dip below and they don't come into contact anymore. What we've seen over the last couple of days is a little bit of a dip in the market. So maybe the market's coming to the realization that with higher interest rates for longer periods of time, there's a very good possibility the market is going to sell off from here. That's my hope. I want if a market sell off will cause the VIX to go up, the VIX comes up, and we can kind of get back into some of that really good trading that we've had for the last 7, 8, 9 months. Having said that, there's no guarantee, so this could come right back up. I'm hoping it doesn't, but you can see that from February 2nd to basically yesterday, the market just has not progressed hardly at all in any direction. We've had some ups and downs, and we've had some good days in there and some bad days in there. But overall, the market is not making any progress long term, and we need this to change. And I can't wait for it to change. So the change is coming, I hope. I believe that there's enough on the table now to make the market. And again, I don't care whether it goes up or down. I just need it to stop doing this stuff. This is the stuff that kills options traders. We can make a lot of money when the market's going up. We can make a lot of money when the market's down. It is tough to make money when the market is moving sideways like this. We have to be more proactive in our trading. We have to be get in and out of trades more often because they reverse course on us more frequently and more violently sometimes. But in any event, that's what's going on with the market right now. I wanted to share one last slide, by the way, just kind of compare the VIX versus the market. You'll notice that the VIX, and this is a percentage, it's not the actual numbers, but over the last 3 months, and I told you this market's just been flat for 3 months, really for the last 2 months, but 3 months total. So the market's in the blue, the VIX is in the blue, but the market's in the red. The market's not making any progress at all, hardly, barely moving at all. The VIX has some good days and some bad days. So we had a couple of spikes maybe in December of 2022. This is only a 3-month chart, by the way. But as you can see, the VIX has been coming down. We've had a couple of days. Right now it's at 20.02. And that's one of the highest it's been lately. You can see that, previous to that, we had a little bit of V dip down there. And that was where it hit, I think, 1760 or 1750 at one point. And of course, you guys know enough now that we like a higher VIX as opposed to a lower VIX. So as the VIX has fallen, it's made trading harder. So, and as the VIX falls, you see a flatter market. And that's what's happened here. If I had extrapolated this out, if I'd shown you, what the last year looked like instead, you would see that when the VIX is a lot more active, when the VIX is higher, you have more ups and downs in the market itself, and that's where we make our money. But right now, both of them are flat. That's given us a flat market, and it's made trading pretty hard. So we have to take some steps. It's not, and by the way, it's not impossible on an intraday basis. We can still make. There's still a lot of money to be made. It's just we have to be more careful about it. We're going to take smaller positions, and if we have to, sometimes we'll take our profits pretty quickly, as opposed to letting them ride a little bit, because the ride is bumpy. If I could show you some intraday charts, I probably should have had some on there, but if I'd shown you some intraday charts, it's not uncommon for a position to be up 20 cents one minute, and then 30 seconds later you're down 40 cents, and then you back up 20 cents, and then back down 60 cents, and then back up 25 cents. It's just, and that's a nightmare for us because we try not to hold positions too long, and we don't want to be underwater. And remember, again, if you're doing 1,000 contracts, every penny move is $1,000. So you might be up $20,000 in one trade, and then that same trade a minute later, or even just a few seconds later, you're down $40,000. And it's tough to be up $20,000 and then find yourself down $40,000 in just in an instant. And then, of course, once you're down 40,000, you got to figure out how to fix that. And typically fix it by hedging. And by the time you hedge it, now the market's back up, and now you're on the wrong side of the trade on the hedge. So at the end of the day, it makes trading difficult for us, but we've got it under control. We're doing shorter holding periods on the options, and of course, I've reduced the number of contracts. So we're making progress to getting back to where we were, but I'm going to need a couple of weeks to kind of get us back to where we were. Having said that, guys, that's all I've got for today. So I'm sorry it was a little bit longer than normal, and sorry about performance from 2 weeks ago. But we used to call this sausage making. We're making sausage, and everybody loves sausage, but nobody likes to watch it being made. Everybody likes the profits, but sometimes we go through periods where we don't have profits, and things get ugly. And 2 weeks ago we got ugly, but we'll get it back, and I'm confident we'll get it back pretty quickly, and I'll do it in a way that's very safe. Having said that, guys, thanks for listening, and we'll talk to you next time.